Hi everyone, welcome back to Save with Jarod. I'm Jarod, and today I'm going to be chatting about investing for beginners. Want to know what that is? Well, let's get into it. This is something that I get asked about a lot. What are the best stocks to invest in if you're starting out? So before we get into that, I think we first need to understand the difference between saving and investing. Saving is the process of stockpiling money, whether it be in a bank account or under your mattress. That was a joke. Seriously, please don't do that. Investing is taking all of that savings and then purchasing assets like shares, properties, unit trusts, and the expectation is that over time, that investment will increase in value. If you buy a house, or let's say some stocks in the JSE, you hope and take a risk that that will increase in value. So now that we have a clearer idea of what investing is, we need to know what investments are made up of. A share portfolio or unit trust is made up of 4 different asset classes, and these are shares in equities, bonds, properties, and cash. I'm going to discuss each one so you know exactly where you can start investing. Number 1, equities or shares. Now, equities just means shares. These are shares traded on the Johannesburg Stock Exchange. A share is a share of a company, meaning you own a little piece or percentage of that company. This is the most risky form of investing. It's important to understand that you buy a percentage of the profit and loss of that company. Shares can make you a lot of money, but it can also lose you an enormous amount of money. You may have heard of people being gifted shares by a long-lost relative when they were kids, and now they're worth hundreds of thousands of rands. Honestly, that is a 1 in a million kind of situation. To purchase shares individually in a single company, you have to know everything about the company. What its vision is, what its projected figures are over the short, medium, and long term. Unless that's your full-time job, it's something that I suggest you stay away from. If you do want to invest in stocks or shares, the best way to go about it is investing in aggressive portfolios in an investment with either a bank or insurance house. They have teams of people called fund managers who do exactly that. They take your money and divide it between a number of different companies across the JSE to split your risk between companies like Naspers, BHP, Apple, Microsoft, and Tencent. This is a great approach for higher risk investing. Chat to your financial advisor and they can recommend a few portfolios for you. Often companies have 20 or top 40 portfolios where they are consistently investing into the top 20 or 40 performing companies. Remember, these portfolios don't have any guarantees. You can make a lot, but there is some risk that comes with it. Ideally, shares are to be invested for the long run or for a minimum of 5 years or more. Stay off those mobile trading apps unless you really know what you're doing. Number 2, bonds. A bond is a tool that is used by governments, local authorities, and companies to borrow money from investors. When an investor buys a bond, they essentially provide a loan to the bond issuer, which is the government or an entity that created that particular bond. As compensation, investors usually then receive regular interest payments from the bond issuers in return. These interest payments stop on the bond's maturity or expiry date, on which bond issuers promise to repay their investors. This is generally the original amount loaned plus the interest. I'm sure you've heard of 5-year or 10-year bonds. Then this is exactly what it is. For instance, if you invested 1,000 Rand into a 5-year RSA fixed rate retail savings bond with an 8.5% yield, you would receive 85 Rand, which is 8.5% of 1,000 Rand in interest each year for 5 years. At the maturity date, you would also be repaid the original 1,000 Rand investment amount. Bonds are definitely less risky than equities. They generally have a guaranteed amount that is given to you over the selected period. These can easily be bought online, and believe it or not, You can actually buy them at the post office. If you want a secure investment, then this is definitely a route to consider. Number 3, property. Now, property is without a doubt one of the most widely invested in things. There are many ways to invest in property, beginning with buying your own home or investing in a buy-to-let property and becoming a landlord. However, you don't have to invest in a bricks and mortar house to invest in property. Other options worth considering include investing in listed property through a real estate office or through stocks. Most insurance and investment companies have portfolios where they invest into their commercial properties such as malls, business parks, and other business-based properties. Considering the large startup cost of purchasing a house or apartment to invest in, like bond fees, transfer fees, financing fees, which can be tens of thousands of rands, this is really a good way to go. Property is a safe method of investing and is something that has also been invested in for a number of years and not just for the short term. Most investment companies like Old Mutual, Sanlam, etc. have a number of property-only portfolios. Consider this before investing into real estate. Number 4, cash. Cash investments can refer to investing money in high interest or fixed deposit bank accounts, or investing in a money market fund which may hold treasury bills, commercial papers, short-term certificates of deposits, otherwise known as CDs, and short-term bonds with maturity dates of less than a year. However, while cash investments offer great capital protection and low risk, it also offers lower returns than other asset classes and is generally not suitable as a long-term investment and often will not outperform inflation. This is designed for securing and maintaining your wealth as opposed to growing your wealth. There's not much more to say about cash investments as they are very straightforward. It's also important to note that with cash investments, growth is taxed when matured through capital gains tax. That can be deducted though from your annual interest exemption limits at SARS. Now, with everything that I've said, you can now decide what you want to invest in. Remember, the higher the performance, the higher your risk will be. It's important for us, before we start investing, to really think carefully of how we want to grow our money. Are we in for the long haul or short-term gain? The shorter the period, the higher the risk. Thanks so much for watching, and I really hope that this has added some value to your life. Share this with as many people as you like, if you feel it can help them. And if you feel that this has helped you personally, consider subscribing to see more videos like this. Hit that like button if you haven't already, and remember, keep saving.